Hey folks, Dan Frio here with your market update for September 16th, 2024. So last week we had a good reaction with mortgage rates. Look, they're almost teetering at 5% or 5.99 now. So what's going to happen this week? Well, this week is Fed week and nothing but the Fed week. So the Feds are just going to dominate all the airwaves. When you talk stocks, you're going to say, well, what's the Fed going to do? When you talk interest rates, well, what's the Fed going to do? So let's see the economic news that we have for this week. And then we're going to go over and do some commentary on an interview CNBC did with a young lady saying, what's the Fed supposed to do and how are the markets going to react to that? And then she gave us some investment advice. And I'm going to analyze that and then give you guys the number one choice in the sector that she's putting her clients in. So without further ado, let's get to why you're here. It's these things. So mortgage rates, like I said, they were basically teetering on doing nothing on Friday, but they had a nice reaction last week. So let's go over and see what's going to happen this week. So right through here's the economic calendar we have for the week. There's nothing going on today. Tuesday, we have core retail sales and retail sales. That's right before the Federal Reserve comes out on Wednesday. Yes, the Federal Reserve's coming out on Wednesday. This is the FOMC. That means the Federal Reserve. They're going to come out and tell us exactly what they're going to do. So we're basically the markets are on standby because of that. But let's get over to CNBC, and this young lady is actually going to tell us what the Federal Reserve most likely is going to do, how the markets are going to react, and then where they're putting their clients in when it comes to investments. Are they in stocks, equities, bonds? Where are they? So we're going to analyze all this in just this one video. So let's go through this interview right through here, and then when we come back, I'll put what she puts in layman's terms for you guys, and then I'll give you some investment advice, and then I'll give you my information. So if you're looking to maybe buy that first house, maybe first investment property, maybe to look to refinance, I'd love to help you because I'm actually a mortgage loan officer. So without further ado, let's get to Miss Duff over here with her take on the market.
I want to see how you see today shaping up. What's your WEX word of the day?
Well, my WEX word of the day is the Fed, because I think that this whole week is going to be dominated by central bank news, predominantly the Fed's messaging that we get later this week.
All right, so you say it's all about the messaging. So if it's about the messaging, does 25 to 50, does that matter, or is it really what Jay...
This goes right into what I've been actually trying to explain to everybody. It's the messaging, not what the Federal Reserve does or did. It's the messaging behind it. Here's a perfect analogy how I want to explain what's going to happen on Wednesday when the Federal Reserve comes out and tells us what they're going to do. Okay, so here's an analysis that Kyle, we were on a live event about a couple weeks ago, and everybody keeps asking, okay, so what's going to take place the day the Federal Reserve cuts rates? Okay, so here's what you guys have to take into consideration. Let's say, for example, and we used Apple stock for this. Okay, just this is a hypothetical, but here's what we're talking about. When the Fed comes out on Wednesday, what are they going to do? Okay, so what are the markets going to do? Here's our basically analogy of this. Okay, so let's say Apple earnings are going to come out on Wednesday, and they're going to actually come out and they're going to show us exactly how their earnings are. Okay, so, and how's the stock going to react? We don't know. But a week prior to, Tim Cook, who runs Apple, he comes out and he says, our earnings are going to be really, really, really bad. Well, if you own the stock, would you wait until the earnings actually came out on the 18th? Or would you start selling your stocks immediately knowing the financials are going to be bad? Well, most likely you're going to start selling right there and then. You're not going to wait till the 18th when they actually say, here's the earnings. They're terrible like we told you. So that's what happens with the Fed. When the Fed's coming out and they're like, okay, we're probably going to cut rates on Wednesday. Well, they've been giving us this feedback or this data for the last, couple years. But in the last couple weeks or 30 days or 60 days or even the last couple months, we saw inflation coming down dramatically. And that's signaling now that the Federal Reserve, basically they opened their hand about 3 weeks ago at Jackson Hole and said, we're going to start cutting rates. So we know they're going to cut rates. Okay, so that's what I want to say. So when she says the messaging, we have to now focus in on what's their messaging. They came out recently and said, okay, we know inflation's coming down pretty substantially, and we're not going to have to wait until it gets to 2. Now we're going to pivot and say, okay, now we're going to take a more of a focus in on the employment numbers or how many people are getting unemployed, and now we're focusing in on that. So that's the whole take behind here. It's the messaging behind it. We don't wait for the day that the news actually comes out. It's the messaging up up to that point. So sorry about the lengthy description there, but let's take it back over here. I want you to explain when she says messaging. Let's just scroll it back just a second. And now you understand when she says the messaging.
Fed's messaging that we get later this week.
All right, so you say it's all about the messaging. So if it's about the messaging, does 25 to 50, does that matter, or is it really what Jay Powell says later?
For me, I think the 25 or 50, I think you could make a perfectly neat case for either one. The 50 could kind of be like a catch-up case. But the messaging, the summary of economic projections and the press conference, I think will matter a lot more.
I want to get your take on what hedge fund billionaire John Paulson said to our colleague Sarah Eisen last week about the Fed and also the speed of these rate cuts. Take a listen.
Personally, I think the Fed is a little behind the curve. Rates are, 5.25 plus, and inflation's down to the 2.5% rate. So we have almost 3% real interest. So I think they've seen enough data that they can start bringing.
What he talked about was the spread between where inflation is today and where the federal funds rate is, where the rate that the Federal Reserve controls. So the rate the Federal Reserve controls right now today, I think, is like 5.33. There's a range. It's 5.25 to 5.5. Okay, so inflation, let's say inflation's at 2.5, like the CPI said the other day. So if we have the federal funds rate at 5.25 to 5.5, we have inflation at 2.5. There's a 3% spread there. That's how much the Federal Reserve can actually cut rates to be at a neutral rate. And when they talk about the neutral rate, that's when they equal. The federal funds rate equals the inflation rate. So let's take it back.
Bringing rates down, and I would suggest more aggressively would be better. So I'd be for a 50 basis point cut rather than 25.
So, Mimi, you kind of say it doesn't really matter. He's saying that we kind of need to see those 50 basis point cut. In your mind, is there an argument that the markets, the economy, they need that 50 basis point cut?
I mean, there certainly is. It's 50-50 priced in right now, right?
Right.
What I was trying to say is I think you could make a case for either. He does point to a fairly aggressive path right now. We have 10 cuts priced in between now and the end of.
Did you hear that? I don't know if it passed you by. I'm going to scan back 10 seconds. There's 10 rate cuts, 10 Fed rate cuts projected on the CME. And I'm going to go over that in a second. But let's go back 10 seconds. Listen to what she said. I hope you didn't miss it.
I think you could make a case for either. He does point to a fairly aggressive path right now. We have 10 cuts priced in between now and the end of 2025, for instance. And I think that's justified as a midpoint, given where the economy is right now. And we are far above what the Fed or what we would perceive as neutral.
All right, so far above neutral. Also, I want to talk to you just very quickly about the valuation of the market. Right now, the S&P trading about 21 times. FactSet put out some data. 10-year average is about 18 times. What does that mean as you look to make moves in this market?
Here's where to stop here. I want to teach you an educational lesson in the stock market, okay? What the PE means is price earnings ratio. Historically, and that number is pretty darn close, is 18. It's like 17.1 historically. Right now, I'm coming up with the S&P the PE ratio there is like 27, but he's saying it's 21. So this basically means historically, people are paying higher prices for stocks today than they did historically. So that means stocks are pretty frothy when it comes to their prices. On average, their prices are 18 times their yearly earnings. So you take their yearly earnings, multiply it by 18, that's their stock price. Okay, that's the historic average. Today it's at 21. So again, it's telling you that the market's a little bit, I'll say, overbought at this time. So I just want to explain that to you in that segment there.
Market, the fact that we're trading at that type of evaluation.
Yeah, so we've been underweight equities, overweight fixed income because.
Okay, pay attention to this. I'm sorry I'm interrupting so much. That's why she's saying, when she says equities, she's talking about stocks. Okay, she's saying we're underweight in stocks and we're overweight in other areas like bonds and things like that. So I apologize for interrupting so many times.
We thought that portfolio would perform better in a range of scenarios, right? If we do slide into a shallow recession or anything like that. Having said that, within the equity exposure, we are looking for to see things broaden out a little bit, like your last guest was saying. And we do like defensive sectors like consumer staples and healthcare.
You mentioned your overweight bonds. I'm kind of looking at your pick for us today as bonds. We're going to show the bond board right now. I'm looking at the 1 year yield above 4%. And you look at the 30-year yield almost at 4%. Do you play the short end? Do you play the long end? I mean, do you want to lock?
Look at these yields you can get. Remember 3, 4, 5 years ago, when if you had money in savings, you were getting about 0.004. Look where they are now. You can buy a 1 year Treasury, which has 0% of default, and you get 4%. On a 2 year, you'll get 3.5%. On a 10 year, you'll get 3.6%. So so let's let her take it from there. But those are pretty decent returns, just for a 1 year return, just sticking your money in, basically in a mattress and getting 4%. Not a bad yield. But let's see where she's putting her clients at this time.
Again, that almost 4% yield, is that worthwhile? Even the 20 year above 4% as well.
The projections are terrible for the deficit, so it's hard to say. It's hard to get excited.
Did she mention the deficit and how that plays a role into this thing? There's the deficit, folks. It's sitting at $35 trillion, and look at those numbers just skyrocketed. That's how much money our federal government is spending. We're overspending every second that we're sitting here talking. This is how much money is being spent or used just to pay the interest on this thing. So, sorry, I know I'm interrupting her a lot today, but there's a lot to dig into in this interview.
Excited about the very long end. The position in bonds is something that we've held on to. We think that there's nothing unreasonable about them right now. But if I were to take a new long, it would probably be in the belly.
Actually, it'd be in the belly. I have to ask you, and I'm surprised more people aren't talking about the short end, the 1 year. I mean, 4%. We're expecting some volatility in the markets in coming months, and then after 1 year, you have your cash back available. Why isn't that a big pick or a 6 month or shorter end ones?
Yeah, look, we have cash in the portfolios too, and I think it's fine to ride the front end, but that's not a very long-term play, certainly. Right now, we are entering, as you said, an easing cycle. It's not going to be a one and done. This is a cycle that we're coming up upon.
So she admits the Federal Reserve is supposed to cut 10 times between now and basically this time next year. And here it is. Here's the CME FedWatch tool. So what this is telling us, if you go through here, it's what's the probability that the Federal Reserve will change the federal funds rate in the future. So here's the table that we get explaining what the federal funds rate is in the chart. So right along through the top through here, you're going to see numbers. So like, for example, right through here, this 500 to 525, 525, that means the rate is 5% to 5.25%. Right now, we're in a cell that would be right here, a column that would be right here. It's 5.25 to 5.5. Okay, but they're saying there's going to be 10 cuts. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 cuts. And in a year's time, there's a 90% probability that we're going to be right through here. Okay, so again, folks, we're all the way over in this cell here, 5.25 to 5.5. So they're expecting us to drop a long way. Am I there? No, I'm not there. I'm predicting a 50 basis points cut here, 50 basis points going forward. They're saying it's going to be kind of a flip-flop at the next meeting, what they're going to do, 25 or 50 basis points up from the Fed. And then from there at the November meeting, we'll be all the way down to this section right here. So there's a 50 basis point cut somewhere in here. I'm just not on that bandwagon just yet. So let's get over to here. Here's where he was talking about the S&P 500, the PE ratio behind this. He's saying it was 18. It's actually 19.4 if you go with historic. He was using a 10-year average, so historically it's a little bit higher. And this is saying right now the PE ratio is 29%. So it's pretty frothy. This basically tells me the market's a little bit overbought at this time. So let's get over to here. She says she's getting into the belly of bonds. So what that means is basically midterm bonds. So I did a little scan through here, named the 5 ETFs with midterm bond treasuries right through here. So I wanted to show you how this works. So this one's saying if you bought the government GOVT, you're buying a whole basket of government bonds. And again, there's no chance of default. What's this fund been doing? Well, here's what it looks like. So it's trading at $23.63 a share. It's up 0.15 today. Over the last 6 months, it's up 4%. This is telling you right through here, you're getting a nice yield too on your money there as well. So that's what's going on right now in the markets. So let's get back over to see what the bond market is doing right now. We have the MBS up 1 tick. That's not enough to really do anything. So mortgage rates are going to stay steady right through here. Let's look at the equity markets. Dow Jones is doing well. A couple other indices are down just a little bit. Is there any news to tell us? Let's just do it says right through here, S&P 500 is flat ahead of the Fed's decision. So basically they're just waiting to see what the Fed does. Let's see what cryptocurrency is doing. I think it gave back a little bit. Yeah, it's hit 60,000 just recently. Now it's down another 22,000. Might give you an entry point a little bit cheaper there. But again, guys, don't do what I say. Just use this as entertainment and educational purposes only. I don't want you to trade on what I'm doing. I'm going to give you some ideas, and I want you guys to dig in and do all your research. So my name is Dan Frio. What I do is actually I'm a mortgage loan officer. If you're out there trying to buy your first house, maybe your first investment property, looking to refinance, I probably got about 10 people a day asking me. They're like, Dan, I closed at 7.5. Should I refinance now? I'm going to tell you right now, maybe. Maybe. What I want you guys to do is if you're looking or contemplating refinancing, let me know where you live. Give me the details. Let's look at the costs involved in this. Because if the costs are really hefty, that's going to cut your savings quite a bit. So if the cost is really cheap, maybe refinance now, and if rates just keep going down the 10 times that they're supposed to decrease over the next year, refinance again. Okay, but if it's going to cost you $2,000, $3,000, $4,000, $5,000, you're going to want to time that a little bit more perfect so you don't have to just keep churning those costs. So I'd love to help you navigate that. I'd love to help you navigate if you're trying to buy that first house. If you're trying to buy that first house, I need you to use the Grant Finder tab right up through there. It's going to give you grants for national grant programs, and also if you live in the Chicagoland area, it's going to give you the Collier County grants there. But if you're looking to just get the ball rolling, hit the Apply Now button or scroll down and you're going to find our 800 number. Our 800 number is 844-775-5626, or you can email me personally, and yes, it's me, at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic afternoon. I'll be back here at the closing bell to let you know how all this mess settled down for the day. So take care. I'll see you later this afternoon. Bye-bye.